Hey everyone, welcome back to Money Quest Broker. Today we're chasing a curiosity that's been on a lot of investors' minds. Why Warren Buffett, the man they call the Oracle of Omaha, didn't rush into the AI gold rush. Not because he hates technology, not because he's stuck in the past, but because the way he looks at businesses is old school, stubborn, and maybe more useful than ever. If you want investing sense without the hype, you're in the right place. And before we dive in, do me a quick favor. Hit subscribe to Money Quest Broker so you never miss out on clear and practical market breakdowns. Now let me hit you with the hook. Imagine this. Warren Buffett sees a deep-fake video of himself that looks so convincing it gives him chills. His reaction? He admits he doesn't really understand AI the way technologists do, and he compares its risks to something as dangerous as nuclear weapons. He even warned that AI could be a genie we can't put back in the bottle. Meanwhile, Wall Street was in a frenzy. Nvidia was exploding in value. AI software companies were minting paper fortunes, and everyone was asking, "Where's Buffett? Why isn't he joining the stampede?" Stick with me until the end, because I'll share the single practical test Buffett would use before touching any AI stock. To understand Buffett's decision, you need to know his rulebook. He's been saying the same thing for decades. Invest only within your circle of competence. That means buying companies you can understand, ones with predictable cash flows, durable competitive advantages, and trustworthy management. If a business's future looks like a straight line you can reasonably forecast, it fits his framework. If it depends on constantly shifting technology, on unpredictable innovation, or on breakthroughs that may or may not come, he steps back. When Buffett talks about AI, he's unusually blunt. At Berkshire Hathaway's shareholder meeting, he said outright that he doesn't understand the technology deeply enough. He's worried about scams, fraud, and how bad actors might use AI. He compared its risks to the invention of the atomic bomb, something powerful that changes the world forever but comes with dangers we can't fully control. For an investor like Buffett, who built his fortune on predictability, those kinds of unknowns are deal breakers. Now let's look at the evidence in his portfolio. Berkshire's biggest holdings really tell the story: Apple, American Express, Bank of America, Coca-Cola, and Chevron. Apple is actually Berkshire's single largest holding, making up more than 1/5 of the entire portfolio. Buffett treated Apple less like a speculative tech bet and more like a consumer franchise with unmatched customer loyalty. Berkshire also owns some Amazon. Not a huge position, but it gives him another indirect window into AI infrastructure. But what you won't find, at least in recent public filings, are massive direct bets on pure AI chip makers like Nvidia or on software startups built entirely around artificial intelligence. Buffett seems fine with owning companies that use AI or benefit from it indirectly, but he hasn't been willing to bet heavily on the narrow, high-multiple AI leaders themselves. That's a huge signal. Let's put some numbers on this, because Buffett always looks at the numbers. Apple, his biggest holding, has a dividend yield of about 0.4%. It's not high, but Buffett views Apple as a cash printing machine with sticky customers. Coca-Cola, one of his oldest loves, yields closer to 3%. Chevron, another significant holding, pays more than 4%. These are reliable income generators that kick off cash year after year. Now compare that to Nvidia, the crown jewel of AI. Its dividend yield is basically negligible, about 0.02%. Nvidia's story isn't about steady cash flow to shareholders, it's about hyper-growth. That difference, income and predictability versus rapid-fire growth, is the exact divide between Buffett's style and the AI frenzy. He's comfortable paying up for certainty, he's uncomfortable paying up for hype. So why does AI break Buffett's rules? There are a few reasons. First, predictability. AI companies can be winners one year and losers the next as technology leaps forward. That makes forecasting long-term cash flows incredibly difficult. Second, valuation. Many AI leaders trade at sky-high multiples, pricing in years of flawless execution. Buffett has always warned against paying too much for a growth story. Third, moats. In AI, competitive advantages can crumble quickly. A new model, a better chip, and suddenly yesterday's leader is forgotten. Fourth, risks beyond the numbers. Buffett openly worries about how AI could be abused, about regulation, about reputational damage to companies in this space. Those aren't risks you can plug into a spreadsheet, and that makes him cautious.
But here's the important nuance. Buffett isn't against AI. He understands it will reshape industries. He just prefers to own the beneficiaries of AI adoption. Companies with established economics that can integrate AI to become more efficient or sell more products, instead of betting on the AI disruptors themselves. Apple uses AI to improve the iPhone experience. Coca-Cola leverages AI for marketing and distribution. Banks are deploying AI for fraud detection. Those are indirect ways Buffett is exposed to AI without abandoning his playbook.
Now let's circle back to that promised Buffett-style test for separating hype from investable opportunity. It's simple but powerful. Ask yourself, if this company's growth rate gets cut in half, does it still generate strong revenue and free cash flow? If the answer is yes, if it still has loyal customers, repeatable earnings, and management that knows how to allocate capital, then it's closer to something Buffett might consider. If the answer is no, if the story only works when growth is explosive and valuations are stretched, then it's probably not the Buffett way.
And that's the core of why he hasn't gone all in on AI stocks. Not because they can't make money, not because they won't change the world, but because he can't see a clear, steady line of cash flow stretching out into the future. For Buffett, investing is about buying a business you'd be happy to own forever, not speculating on a story you hope keeps growing. So what do you think? Is Buffett being too cautious, or is he showing us the discipline most of us lack when the headlines get loud? Drop your thoughts in the comments, and while you're at it, make sure you hit subscribe to Money Quest Broker. I'll keep bringing you the kind of breakdowns that cut through the noise and focus on what really matters for investors. And one final note, this video is educational only. I'm not your financial advisor. Do your own research, think about your own risk tolerance, and always consult a licensed professional before making investing decisions. Thanks for watching, and I'll see you in the next one.